Hey guys, it's Kevin Wadsworth and Patrick Karim, NorthStarBadShots.com, and we've got a guest with us today. We're really pleased to welcome Julian Brigden from Macro Intelligence. Julian, would you like to introduce yourself and say hi to everyone?
Sure. Hello, everyone. So I am the co-founder of MI2 Partners, Macro Intelligence 2, and we're a macro policy consultancy sort of group, and we set ourselves up a decade ago now. It's been going that long, blimey. I guess it's probably, you can see it from the grey hairs on the side here. But so far so good, and we've had a pretty decent run. If for those of you who follow me on Twitter or clients, you'll have seen our view on inflation, which we've been pushing hard for the last 2 years, and now I think we're just at a very interesting perspective in terms of market. So let's dig in, guys. Let's kick it off.
Yeah, well, Patrick, I think, was just about ready to share a chart there. We're looking just before we started recording there at the euro dollar chart and just considering what might possibly be going on in the Eurozone. And you'd hinted that you thought things weren't looking good. So perhaps.
Well, I think, look, I mean, I'm trying to keep a somewhat sort of sanguine view on Europe, right? I mean, I think there's an awful lot of pessimism priced into Europe. There's an awful lot of, or there has been until recently, an awful lot of excess optimism priced into the US. And, obviously things changed materially with Ukraine. That really was a significant shock in terms of trade shock to Europe, which, justifies some of the moves that we've subsequently seen. But even now, things could go better in Europe. They really could. Right, we could see Putin decide not to go, full nuclear, and by that I mean not nuclear weapon, but not turn the gas off permanently. We could keep the gas flowing. We have an awful lot of inflation pressure in the Eurozone, arguably more than actually in the United States. And then the ECB can find themselves, woefully behind the curve. And they end up having to raise rates enormously, and the euro rises, and the dollar's in for the top's in for the dollar, etc., etc. But it seems that by the end of this week, we will know which way this thing is breaking, because obviously we've got this temporary shutdown of Nord Stream 1, the pipeline running into Germany. And there is the growing risk that Putin will not turn this gas back on, that he will leave it off. And when you look at the stars, if that is indeed the case, things could actually get extraordinarily ugly in the Eurozone. So we're almost looking at a binary kind of outcome. And that's what sort of worries me. As I look at a euro, which to my mind, from a technical perspective, and I'm just looking at some simple things. So if I share my one chart here, you can see this is a monthly chart in the euro. We've been in this kind of downward channel since 2006, 2007. We now have this pretty clear head and shoulders pattern. Took out the neckline here at around 108. We took out this horizontal support here at around 103.5. Now we're bouncing. And we could bounce all week. Remember, we got the ECB. I think they're going to go 50. I think they're going to hang pretty tough and be hawkish. So maybe we can bounce. But if you can't get above 103.5, and if Putin does turn the gas off, that really opens up the prospects of coming into these low 80s. So kind of where we were in 2000, 2001. And I think obviously that would be pretty problematic. And then when you also look at other things that are going on in Europe, the consumer confidence has imploded. I think rightly so. I mean, the threat of global thermonuclear war on your doorstep would tend to probably dampen your ardor as a consumer. But it is at levels, gentlemen, where it is truly through the lows of the global financial crisis. And if it stays there, and it has in the past led business confidence. The business confidence, particularly if this gas gets turned off, is following. It's doing its Wile E. Coyote moment at the moment. You know, businesses are going, everything's fine, and they haven't seen that the consumer's already hit the bottom of the ravine, and they're about to follow. And if that's the case, you're looking at a very ugly recession in Europe. You're looking at with the backdrop of sticky, horrible inflation still. You're looking, a stagflationary environment is a nightmare for a policy body to deal with, because you can't ease rates to offset the growth collapse, and yet you can't tighten rates to, you know, offset the inflation. So what tends to happen is your bond market tends to get clattered and your currency tends to get clattered. And when you look at the bond market, obviously the one that we've been focused on since the spring is BTPs. And we just had a very, very ugly move in BTPs at the end of last week, which I don't think many people watched. So everyone's been focused on spreads between BTPs and bonds blowing out, right? And they've been saying, oh my goodness, you know, rates are too high. You know, this is all going to go. This is a sign of the market betting against Italy. It's not, right? In a global environment where bond yields have risen and BTPs are definitionally a poor quality asset, right, given the debt levels and the growth in the Italian economy, the fact that BTP yields have risen in absolute terms in an environment of overall rising bond yields is not a problem. What happened at the end of last week is a problem. And that is when you started to see a very abrupt move at the front end of the Italian bond market in 2 and 3 year BTPs. Because that, when you go from a steepener, which we were as the long end yields push higher, okay, to a flattener where short-term yields are rising higher, is the sign that the bond market is starting to get worried about default risk rising in Italy. Because the way duration works, you have to, if you were ever to see Italy default, and let's say they haircut all Italian debt by 25%, because of the way duration works on a bond, the front end actually has to sell off more than the long end to price that 25% in evenly across the curve. And it's actually this in 2011 and 2012, this inversion, this bond flattening, which caused Mario Draghi to do whatever it takes. So let's just fast forward a week and say Putin turns off the gas. The European consumer is right. Growth really is about to implode. At the same time, the ECB is dealing with an inflation problem, which they can't address, right? Because growth is imploding. The currency absolute gets annihilated. And, oh, the Italian bond market starts to fall out of bed. And, oh, by the way, the Germans are saying now they don't want a separate bailout package fragmentation tool because, by the way, you've got one. Right? We've got a program which Mario Draghi designed himself, right? The OMT program. It's just the Italians won't be able to deliver on it because it requires austerity, which is why they don't want it, right? So you could see things unravel in Europe at a pretty prestigious rate. And I think that would be the classic sign that you get of a blow off move in the dollar because the euro goes to 80. Right, it's going to destroy a lot of stuff. So I look at this market now and go, and I've been saying this to clients, things have come kind of a long way, right? In equities, risk has come down a lot. We bought some stocks at the, last week, some XME, some of these mining and metal things that just got absolutely blown up. I'm inclined to even buy some crypto down at these levels. But by the end of the week, the picture could just turn out to be the eye of the storm, and next week we could be in a complete shit show again.
Yeah, that's certainly one way of putting it. I mean, some of the longer term charts do, myself and Patrick have been looking at, do paint a potential very frightening sort of set of scenarios. Certainly with NASDAQ, S&P, very much looking from a broad perspective as though they're just, a heartbeat away from confirming that this isn't just a retest of key moving averages, and this isn't just a standard retrace, and this could indeed be something that drags on not for months but for years.
Yes,
looking at the 1970s and looking at what occurred during the 1970s, and certainly looking at the ratio charts. If you look at, for example, the ratio of SPX to commodities, or the ratio of SPX to precious metals, there are some pretty strong pieces of evidence there that we are seeing a rotation from one sector to another, very large transfer of wealth, if you want to put it that way, out of SPX and towards commodities, and notwithstanding recent pullbacks in commodities and precious metals, but I'm talking about the longer term trend, which appears to be somewhat changing at the moment.
Yeah, I mean, I'm completely in agreement. I mean, I was looking at, something, we put out some charts to clients the other day, and if you look at the, if you're going to take the NYSE against nominal GDP, right? We have seen, this is the 5th in the last, since 1966, we've had 5 highs where the ratio has got anywhere this close. So, hold on 1 second. Okay, share, I'll show you.
It's cool. Just whilst you're doing that, Julian, just something that has always, that I've been looking at for a while now, just to put into context how historic, what's going on is. The German PPI, for example, is way beyond anything that has preceded in the 1970s or even post-war.
Correct.
Where the producer price index year on year for Germany is, well, to put it bluntly, we need to extend the scale upwards, because it's moved in a very sort of vertical, parabolic fashion.
People, if you look at Slovakia, right, which people may go where, but Slovakia is one of those. It's like Europe's Mexico, right? It's a screwdriver factory for subcomponents and products for Western Europe. Their PPI just basically went to 50%, 50% year over year. But look, so here's the NYSE. So very broad metric of the US equity market, right? All the ADRs, all listed stocks, 1,500 listed stocks, et cetera, Here is it against nominal GDP, right? So we've had 4 other highs, and this would be the highest. This would be the 5th and the highest highs in this sort of region, right?
Yeah.
If we're lucky, this is 1967, where the correction was only 22%. If we're lucky, the average correction is 40.
Yeah.
And that strikes me as entirely reasonable, in which case we're less than halfway.
Yeah. Yeah, and another way of looking at this that myself and Patrick were looking at yesterday was when you price the S&P using inflation. So if you use the PPI as a proxy for inflation, so the SPX versus PPI, then looking back at the 1970s, that drifted sideways effectively for around about 20 years. Yeah. So I think this is an element that people very often forget. And also when you're talking about DXY, people will refer to DXY and be unaware of the fact that in the period of time that it's moved from around about 75 or 80 on the DXY to where we are today at 105 or wherever it is, gold, for example, has moved up several $100s. So the simple statement that a rising DXY is bad for gold is often sort of true to an extent in the short term, but over longer time periods, the reason that has happened is because people forget that inflation is going on all around them. Gold is an ultimate barometer, of course, for that, and gold just sits there effectively measuring your purchasing power. So if you measure DXY using the PPI, then it looks very, very different. DXY is a simple index number that is effectively measuring DXY, US dollar against the euro, isn't it? But if you factor inflation into that, you get a very, very interesting chart that periodically breaks down. And when that chart does break down, what it's showing in essence is that over a short time frame of, let's say, a few months to a few years, it's showing that the US dollar and the way it gains against the euro is not able to counteract inflation. So if DXY is rising, if the US dollar index is rising, but inflation is killing that, then the US dollar index adjusted for inflation breaks down. Pat's got the chart here, and you can see very clearly how different this chart looks to DXY, but how similar it looks to, is that gold you've got there? Inverted chart for gold.
I inversed the gold chart just to overlay it. I don't know if you've seen this chart before, Julian, but it's like the inflation adjusted DXY, and maybe you have some hints, some like hindsight or insights on why this is happening. But gold tracks essentially the DXY, but
inflation adjusted DXY.
Exactly, like practically to a T. And
and
it totally broke down here. So even if the DXY is strong versus the euro, right now, there's so much inflation
it's not in real terms. It's kind of like a real adjusted exchange rate.
Yeah, they're both losing to inflation, and it's a question of which is losing to inflation the most. It's an interesting concept to get your head around, but that explains why gold can rise when DXY is rising, because the missing link is inflation.
I'm curious, Julian, how the hell do we get out of here? Do we need 10 years of pain, of multiple recessions until like we expunge? What's the roadmap out of this madness?
It's really
Is there an easy way out? Is there a way out that doesn't involve
out.
complete collapse?
There really isn't an easy way out. I mean, you can argue that it's a period of pain. If you're a central banker, you say, okay, right. So you gird your loins now. You say, right, I'm not going to let this be the 70s. Okay. So you raise rates, you try and address the issues. The problem is you're dealing with such a highly financialized economy that the minute that you deliver that pain and the equity market collapses, you can start your stop clock on when the economy goes with it. Right? I mean, I've done correlations between the S&P and ISMs. I've done correlations between the S&P and jobs, and they're the same thing, right? Because because the problem is CEOs aren't paid to produce anything. They're just simply shepherds of an equity price. And so the minute that the equity market goes down, they start to cut costs in terms of employment or capex or so on and so forth. So that leaves central banks at that point in a very difficult situation, that they've got a collapsing economy. So then they look around and they go, what do we do again? And you're back down to the zero bound again. And so you probably end up having to do more balance sheet expansion again. And so you end up in this situation where at that point, then the dollar slides again, and maybe we'll be lucky and we'll get a bout of growth again. But the efficacy of that trade seems to be falling. And I think it doesn't solve the problem. You end up embedding inflation probably again into the system, because you won't have fully wrung it out, right? I mean, I look at Powell and I hear what he's saying in terms of his earnest to want to tackle inflation, but I look him in the eye and go, is this guy really Volcker 2.0? But is he really prepared to do what is necessary? And I think he believes he is, but I'm not sure he can, because I'm not sure he can live with the pain that it is going to cause. I mean, if this equity market is going to drop 40%, like it did, in 1969, right, or 2000, right? And I've drawn the parallels to the equity market in the US and the 2000 bubble, right, on many occasions. Can he do that? And I don't think so. So I think we end up in this churn where it isn't necessarily good, right? And I think it's a very, very painful process where wealth destruction can be inordinate, right? And if I look at how we're set up, I mean, at the beginning of 2001, the first piece that we wrote was, we said that inflation was going to be the most important variable in 2021. and that proved to be the case. And at the beginning of this year, what we wrote was the most important variable is going to be boom bust economics, and we are going back into those late 1960s, 70s boom bust economics, where literally the economy starts and it stops. And I've had some wealth clients who've done work on this, and that's a horrible environment for wealth preservation, because literally your efficient frontier between equities and bonds, which is should be theoretically about 45 degrees, goes from here to here to here instantly, right? And so 1 minute you're meant to own no growth, the next minute you're meant to own only growth, right? 1 minute you're meant to own no dollars, the next minute you're supposed to own only dollars. And people just can't move quickly enough, particularly in a world where they've got so used to passive management delivering all their returns. Right? Even I look at myself, and I just, and I said this on Real Vision with Raoul the other day, I think macro is back with a vengeance, but we'll be bloody lucky if we catch every single turn, because this could become so insanely vicious, these moves, that's going to be incredibly scary. And you should understand, if this thing comes right, most people will end up poorer at the end of this materially. And just sitting there and saying, well, I just want to own gold, to be honest, won't necessarily be enough. You're going to have to actively trade this thing the whole time.
You're scaring me, Julian. Jesus.
Look, I scare myself. I mean, if I look at my personal wealth, most of it's tied up in assets which are quite difficult for me to trade, right? Be they pensions or, which are part of the company but are managed by external managers. And I've got a pool of cash that I can actively manage. But I'm looking at this and going, does this pool of cash that I have to actually be short the whole thing? Short, because I have to offset all these other assets, which I can't. I can't trade a house, right? And if you look at the correlation between the NYSE and the US housing market, it's basically one jet. I mean, you want a frightening bloody chart, right? When people are trying to manage their portfolios, just think how big actually your portfolio is, because it could be much, much bigger than you realize. So let's do share. Look at that.
Jesus. Yeah. Capital flows, Kevin. It's all about capital flows. And when they exit the NYSE, they're going to exit the housing.
Right. I mean, but it's the same trade, right? It's the same, particularly, really since this period here, right? And since 08, 09, right? It's the same thing. I mean, this is kind of scary, right? So how do you manage it? You want to grow your wealth ideally, but worst case scenario, you don't want to lose your wealth. Well, let's say you're a high net worth individual and you've got $1 million house of which you own, 400 grand, and you've got $1 million pension plan, and you've got a few $100 grand of cash or, tradable assets. Well, if your $1.5 million house pension fund goes down 30%, you got to be bloody short with your cash. Like, holding cash is not enough. You got to be short to offset that wealth destruction you're going to see in other places. I mean, this is really, really tough environment.
Yeah, it's a very sobering message there. But I think you're right. That sort of wealth destruction that takes place in this kind of environment is it's probably going to leave a lot of people a lot poorer over the next sort of 5 to 10 years. And for the average investor, it's going to be incredibly difficult to stay on top of this. You can't, as you say, you can't just keep buying the same old stocks.
Right, the average investor is going to get poorer.
Yeah.
Yeah, because they, like you said, if you look at a pie chart of people's wealth, it's mostly all in their house. Average people in their house and their car, so they have no, they can't sell the house, right? And they have no money to short
and maybe you could say, well, look, it doesn't matter because they live somewhere, right? They've got to live somewhere. So maybe the house depends when they bought it, right? I feel sorry for these millennials. I mean, I had this friend of mine who called me up from Denver, and she's a mining engineer, super smart girl. And she's called me up 3 months ago, and she said, I found a house. It's on the market for 900,000, but I think I can get it for 1.2. What do you think? And I said to her, look, if I told you to go and borrow money and put $1.2 million in the US equity market right here, right now, would you do it? And she went, no way. And I said, well, and I sent her that chart and I said, it's the same trade.
Yeah. That's a pretty, pretty good way of sort of making the case, isn't it? When you got 10% inflation across the Eurozone, and some countries, my brother lives in Poland and they've got 16% there, whatever you're investing in, you got to make 16% annually before you're even keeping up with inflation.
Yeah, but I do think that's a bit of a farce. I mean, I agree with you, right?
Oh,
cash gives you an optionality, which you don't get from being fully invested.
I agree.
Don't get me wrong. In a slow kind of bleeding market, cash hurts, but for 2 or 3 months, I'm fine sitting in cash. If I think I'm going to get a 30% move, right?
Yeah. On the short term, we saw it like over time, cash. We saw that chart, that inflation adjusted. It's nonsense. But on the short term, I agree. Like wait for the flush, wait for like a new trend. You could play on the monthly chart, something that you could play a 2, 3, 4 year trade. But I'm super happy to see you do charts, man. I'm impressed, Julian. It's cool. I like it helps crystallize the vision. Like people sometimes they say something, but without a chart, it's hard to see the time lapse. It's hard to see.
I mean, look, I know my client. I mean, a lot of my clients are hedge funds. These guys are super busy. They need to digest something in 2 minutes, right? And if you can illustrate it in charts, it's so much more impactful. And so that's I think we have 3,200 charts and models that we use.
Yeah. Well, as an ex-meteorologist, a picture paints 1,000 words, and that's very, very true. You can talk all day as a scientist, and nobody's interested. But give them a simple chart, get the message across in 60 seconds. Everyone's happy.
Yep.
Hey, Julian, it was a pleasure. I don't know, like maybe we could catch up after this unwinds a little bit and see how your views change on this macro. So look,
yeah, I want to say right here, right now, I'm actually long a few things, right? But I just think, A, I don't think the flush out has come in the US equity market. And B, I'm getting very worried about Europe, if indeed, I'm hoping not, right? But if Putin turns off the gas, then I think things can move rapidly south in Europe. So my gut tells me we're in the eye of a storm. Okay, how long that eye lasts? Does it last to the end of this week? Does it last? Do the earnings numbers in the US just good enough, right? With just enough, ridiculous guidance. Oh, everything's fine, right? That we delay things till September, October, because once you get into August, we know not much is going to happen, right? And then we have to wait for Q3 earnings to really find, oh my goodness, look at housing or look at this. But you look at some of the speed with which some of these economic metrics are starting to change now. I mean, classic today, National Association of Home Builders, right? Index hasn't gone anywhere for months, right? It's been delusionally high for months. And then it just dropped today 10 points in a straight, actually 12 points in a straight line.
Yeah, I think we're going to be seeing more of that somehow.
Yeah. So I do think I really think we're in the eye of the storm. Short-term technicals are great for trading these kind of things. But this is a time, if you haven't sold into this rally, I think this is a time to sell into the rally. And if you have sold, you can cover some shorts, you can make some profits, and then you look to reset those moves in the next, could be week, could be couple of months. But to my mind, this is not over, because the 16% collapse in the broad US equity market after the highest levels relative to nominal GDP, to my mind, is not enough.
No, I tend to agree.
Yeah, look, yeah, you're feeding my echo bubble, but look, at the end of the day, echo bubble or not, it's the charts are showing that. And until the DXY starts unwinding down, stay clear. There's a reason it's going up, the DXY. People are hoarding cash. It's like,
and there are very clear breakout lines for the S&P, for the Nasdaq, and for cryptos and everything else. And until price moves above those breakout lines, all this is a bullish run within a broader bearish trend. So
correct.
You can't put any particular confidence.
No, I'd rather be.
Yeah.
I've said to people like, "Hey, do you want to buy?" And I'm just like, I'd rather be a little late, frankly, in this environment. If I don't buy the US equity market till 4,200 and then the move goes, I've got some metrics which I watch, which generally give you like a 20 to 30% return from when they cross over. Yeah. So if I miss the next 5%, 6%, and I catch the next 30, I don't care. No, I just don't care. But if I buy now and I commit fully to this thing, and the next move is 30% down, then I'm going to care.
Yeah, exactly. Yeah, and trying to second guess a bearish trend is usually not a clever thing. No,
something has to capitulate before because you're asking central banks to capitulate in an environment where we just printed the highest inflation, since the 1970s, right? I think PPI in the US, the old series, is actually above where it was in the 70s.
Yeah.
24% and climbing. Look, Julian, maybe it's time, a good place to maybe wrap this up and let all our viewers where they could find all your macro analysis, man.
So look, if you're an institutional client, or if you're interested in the product I put out on Real Vision, then just ping us at support@mi2partners.com. So it's MI and then the number 2. So like MI6, but with the number 2. And if you just want to follow me on Twitter, it's Julian@MI2.
Yeah, we'll put all the links in the description, guys. And super honored, Julian, for you to have accepted our invitation to come and talk with us there. And I love the fundamental hindsight, but you build it on charts, which for me adds extra evidence about your narratives about where we're heading there. So that's the best.
Yeah, exactly.
Cool stuff. All right, guys.
Perfect, gents. Thanks
for joining us.
Thank you, Julian.
Bye-bye.
Thank you.
Take care. Bye-bye.